Hello friends, are we in a bear market? This is a burning question that must be on top of the mind recall for almost all traders in the Indian stock market today. Well, last week I told you that the rally that you're talking about is nothing but a bear market rally. This is something that institutions do at the end of every quarter to boost their NAVs on net asset values. And one should not get sucked into the bullish side. The markets validated my hypothesis, and I'm going to pick up the threads where I left them last week and analyze the market for you. And let's see what the statistical data that I'm so used to giving you is indicating in the week ahead. Coming up on your screen is the market roundup window, which tells you that it was the broader based Nifty 50 that saw relatively higher declines as compared to the Bank Nifty. The US dollar index continued its upward march after a brief correction, and that is a cause of concern. I've told you in my earlier videos that India is an importer, net importer, and 2/3 of all our imports are fossil fuels, natural gas and crude oil. And once the dollar gets expensive or stronger compared to the rupee, our landed cost of fuel triggers imported inflation. That's not a very welcome sign. The other thing that I learned in the Southeast Asian currency crisis of 1997-1998 was that countries whose currency fell the hardest versus the US dollar witnessed a balance of payment crisis, because any country that has dollar denominated debt, whether private or sovereign, will find it expensive to service that debt in terms of interest payments, and we are basically going to have redemption that is going to be a lot more expensive. So the US dollar is at a lifetime high versus the Indian rupee. The USD INR, as you are seeing in the market every day, is edging higher. So that's making our markets even more nervous. And the news report that India's crude oil basket has now reached the highest in over a decade, which means imported inflation that I talk about is likely to accelerate from here. Now that is basically reflected in higher gold and silver prices, because inflationary times are a boon for bullion bulls. Crude oil and natural gas continued their rally upwards and basically pressurized the emerging market scenario uniformly. The USD INR, as you can see, gained 0.25%, and the 10-year benchmark bond yield finally closed above the 7.52%. Please don't miss out the bond segment in this video. Now, the NSE market capitalization continued its downward march. We lost a little over 2%, and that's a cause for concern. Do remember, I've told you, statistically speaking, in the past, I have observed whenever the market cap falls more than 4.5% for 4 to 5 weeks in a row, severe downturns have invariably followed. So let's keep an eye on the NSE market cap as well. The MWPL, or market-wide position limits, continued to rise, which is normal till the third week of any derivative cycle. And we are going to cover that in the in-house indicators. The US markets continued their downward fall. And what's really noticeable here is the fact that the broader is the index, the harder it has fallen. So the Dow Jones index, which is the narrowest of them all, fell 4.5%, whereas the Nasdaq and the S&P 500, which are broader than the Dow Jones, fell more than the Dow. The same is seen on the daily chart of both these indices, all these three indices. The fall on Thursday and Friday in the Dow Jones Industrial Average is bone numbing. These are not the kind of declines that you'd expect the bulls to really overcome in a hurry. Do note how there's a death cross. The 50-day moving average is below the 200-day moving average, and the price basically tried to overcome the 50-day moving average resistance, failed and fell back. Similar scenario in the Nasdaq 100 index. A death cross occurred in the month of March itself. The price attempted to go towards the 50-day moving average, failed to even touch it, and sharp declines on Thursday and Friday both have seen the Nasdaq basically pulverizing the bulls. S&P 500, by and far the most broad-based index out of the three that we are discussing today in the US market. Similar death cross here, which means we are basically seeing the bulls are clearly on the ropes here, and markets are seeking equilibrium at lower levels. So these are all the makings of further declines in the coming days. Now I come to our in-house indicators, starting with the MWPL. Now, what is the MWPL? It is our measure of risk appetite of the two marshmallow traders. Don't get confused by the marshmallow theory. You will find a tutorial video on this in the description below this video, as well as in the pinned comment below this video, also as an end screen. So the MWPL is the extent of exposure taken by the market players as compared to the total exposure allowed by the SEBI, or Securities and Exchange Board. So we are at 25.45, and on 16th of November 2021, we saw the highest MWPL in recent times at 35. We have never seen even 30% after December. That tells me that the two marshmallow traders' risk appetite is fairly subdued, it's curtailed, and unless we start making higher peaks on the MWPL chart, I would say that the traders are still showing signs of skepticism at higher levels. The same is made out on the weekly chart of the MWPL. You're basically seeing we are not even going towards the 29% mark. Forget about 35%, which we saw in November. We are not even getting close to 29%. So risk appetite is fairly subdued here. Now let's see the index and stock futures turnover. Do remember this is cumulative figure of 3 consecutive expiries, which is June, July and August. We saw a turnover on the index futures rise marginally, because index futures tend to be relatively lower beta or lower in volatility as compared to individual stocks. Individual stock futures saw a marginal decline in turnover on a week-on-week basis because of higher volatility. Also remember, traders, when they are faced with mark-to-market payouts, tend to clamp up. They tend to clam up and reduce their trading exposure, or at least intraday trades. The same is borne out by the weekly chart of the index and stock futures turnover. As you can see, the stock futures as a red line has fallen, whereas the index futures turnover has risen for a second consecutive week. That tells me that traders are actually resorting to lower risk instruments like the Nifty and the Bank Nifty as compared to individual stock futures, which tend to be higher in the risk rankings. Now let's see the basis. This is again a two marshmallow risk appetite metric. Basis is nothing but the premium paid by the traders to trade any individual or an index derivative. The basis has fallen on both the Nifty and the Bank Nifty on a week-on-week basis. And what I want to watch is whether there is inversion or the basis getting into negative. That is the future trading at a discount to the spot in any index. The Nifty was there, and a fortnight ago it was in inversion zone. It's managed to rise higher, but what we are seeing is that pressure at the upsides is keeping the basis low. The weekly chart of the basis will tell you this in more clearer terms. This is a 20-week look back, 4.5 months. What you are seeing is that basis is at the lower end of this 4.5 month period. That means risk appetite. Traders are not willing to pay a high premium. Risk appetite is lower. And that tells me that a bull market is something that will take a huge amount of effort on the part of buyers to trigger again. Now let's see the advanced decline ratio. This is a one marshmallow risk appetite. Traders who are intraday players who do not roll over their trades to the next trading session. Now, barring Thursday, which turned out to be a day that the markets flattered to deceive the bulls, barring Thursday, where the advanced decline ratio went to 1.09, barely above 1, you're seeing the advanced decline ratio stayed below 1 throughout the remaining part of the week. So even the one marshmallow traders had very poor risk appetite, and therefore I don't think you're seeing this as a bull market. I'm seeing the weekly chart on my screen now, which tells me that the advanced decline ratio remained below 1 for the second consecutive week in a row, and we are now at the lower end of this 20-week or 4.5-month range, which tells me that the buyers are extremely circumspect, they are cautious, they are not showing any signs of being gung-ho or in a hurry to buy. Now, for the impetus, and this is something that you've learned to trust, you've learned to trade with over the last 1 year or more. And the impetus chart tells you that both the Nifty and the Bank Nifty impetus rose in the final 1 or 2 trading sessions last week, and that's really bad news. The bad news is that the markets actually fell sharply and the impetus has also risen, which means that the falls are gaining momentum. So far, if you thought the decline was painful, do note that the decline was on a very low impetus. Now, if the decline continues and the impetus rises, which means the intraday ranges are going to expand, you might possibly see even bigger intraday falls in the coming days. That is what this impetus chart is telling me. When we see this on a weekly time frame, again for a look back period of 20 weeks, 4.5 months, we are seeing that the impetus is at its lower end of that period. Now, I've warned you in the past, don't get too positive about the impetus falling. It merely tells you that it is being compressed like a spring, and once you let go of the subduing pressure, the spring expands and it leaps up. So at any given point in time, you should be ready for volatility to go through the roof, and volatility cuts both ways, on the upside and downsides. And right now, the probability of a down move seems slightly bigger than the probability of an up move, which means that bulls might be in a little bit of more pain in the future if this impetus chart is to be believed. Now let's see the lift weight thrust drag indicator on a daily chart. This is purely for Monday. The percentage gain or loss of the Nifty indicated as a blue line shows a sharp decline on Friday, not unexpected here. But the LWTD has actually risen above 0. That means on Monday, there is a possibility that the bulls might attempt to resist big ticket declines. Am I saying that the market will jump up? Not necessarily. All I'm saying is that the price remains downward, but the lift weight thrust drag indicator is basically showing a potency or a possibility that the bulls might resist declines. Whether they'll win or not, that the market will tell us on Monday. Now for the week-on-week chart of the same LWTD indicator, the Nifty percentage gain or loss is almost at the lowest end of a 20-week period, 4.5-month period. That tells you that the price is seeking equilibrium at lower levels. Declines are likely, but the LWTD has risen, which means the bulls are making an effort. What you saw on Thursday was one small example. The bulls are making an effort to pull the market up, but the price is dragging the sentiments lower. So in a situation where you have to choose between the impetus and the price, do remember the price is the ultimate gauge of it all, and that remains downwards. Now for the footprint of the four types of players out here, I begin with the FIIs, and they've basically cut their exposure, their long exposure on individual stock futures on a week-on-week basis, and they've raised their shorts on the indices, which is why both the arrows are pointing downwards. Where DIIs or domestic investment institutions are concerned, their individual stock futures net shorts have risen, which means their outlook is downwards, and their index shorts have been reduced marginally, very marginally, which means their outlook on the indices is marginally better than last week, which is why a blue arrow here. Where prop traders are concerned, now these are brokers' own self trades, proprietary trades. Since they know who's buying how much and at what price, they are second best to insiders. The one saving grace to data that we are seeing on a week-on-week basis is that prop traders have raised both their index as well as individual stock futures. Is it hope? Is it something more? Is it something more concrete? That the coming 5 trading sessions will tell us. But the prop traders seem to have bought, and these guys don't really make trades for the heck of it. They are a lot more sharper. The last chart is of the retail individual trader. Do remember, the retail guys have been doing all the heavy lifting. They are the ones who pushed the market and brought it where it is now. And they are also holding the largest amount in quantum long positions in futures. So they raised their index and individual stock futures net long positions, which is long minus short. They seem to be holding a positive outlook towards the market. Now, from a behavioral science point of view, this can bring about higher volatility. Why, you might ask me? Because these guys have built up positions on hope, and if their hopes are belied, if their hopes are let down, they will also unwind these positions. So the higher MWPL will result in a bigger fall. Once hope turns to fear, when hope turns to despair, the falling is always slightly sharper. So volatility can go up. Be very careful. The average retail guy is not as savvy because they've not seen bear markets. Their experience is not as big as mutual funds, or whether it is DIIs or FIIs, and they're definitely not as sharp as the prop traders. But for now, prop traders and retail guys seem to be in sync. They are increasing their net long positions. Now, friends, I come to the bond market. This is a very critical aspect of this video, as it has been through the months, through the years. I've been a big votary of watching the bond markets because it is a fountain of money supply for all other asset classes. The chart on your screen is very clear. It's telling us that bond yields are now almost a little over 3-year highs. And average Indian can go to the RBI Retail Direct website and buy government bonds which are 100% central government guaranteed and get yields in excess of 7.5%. Compare that with a fixed deposit which gives you ballpark of 6% but guaranteeing only 5 lakh rupees. Where would you like to invest? If you figure out this riddle, you know why the Nifty and the Bank Nifty are falling. When bond markets are offering you 150 basis points or more higher than a bank fixed deposit with 100% government guarantee against 5 lakh rupees guarantee in fixed deposit, you know money is going to run out of fixed deposits and go to bonds. And when liquidity is sucked out of equity markets, markets tend to seek lower levels. It's as simple as that. Let no one tell you otherwise, but the bond market is a very, very critical element, a factor in the armory of a bank Nifty trader a guy who trades banking stocks, and any equity trader for that matter of fact. Don't ignore the bond yields, otherwise, you will be sorry for it. And bond markets are telling me that the trouble for equity is far from over. With the Monetary Policy Committee or the MPC having raised the repo rates by 0.5%, which is 50 basis points, I believe the possibility exists that the next MPC meeting in August has a fair chance of raising rates even higher, and cheap and easy money is mother's milk to a bull market. The days of cheap and easy money are over, my friends. Somebody is turning off the tap, and you're likely to see reduced flow of money, which is not really very good news for bulls. The bond market's done. I now come to the US dollar index, which is extremely critical for all emerging markets, including India, because we are net importers, and the dollar A is responsible for measuring imported inflation, and B, our balance of payments, the loans that we've taken both at the corporate and government level in dollar denominated currency arrangements. So I see on the daily chart that the Dixie has risen on 4 out of 5 trading sessions, and the price is staying above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull, which tells me that the short-term outlook has turned positive again, which means pressure on equity markets of emerging nations. And the 25-day exponential moving average is turning upwards again, which tells me that the possibility of the recent peak at 105 odd levels may be overcome in the coming few trading sessions. The weekly chart on your screen tells me that the candle is what I would call a power candle, noticeably big, prominent, and powerful in nature. Price remains comfortably above its 25-week exponential moving average, which is a holding on cost of 6 months of an average bull. So the medium-term outlook on the US dollar index also remains positive. Last week, I advocated a range between 103.70 on the upside and 100.60 on the downside, which was overcome by 40 points rather, on the upside, because the high was 104.10. Now, in the coming week, I expect a range between 105.75 to 102.60. Do monitor the dollar index very carefully, my friends. The dollar index done, I now move to the bank Nifty, which basically took it on the chin, fell 2.24% on a week-on-week basis, and registered declines on 3 out of 5 trading sessions. It maintained a lower tops and lower bottoms formation. The daily chart on your screen tells you that a death cross has been confirmed. As you can see, the thick prominent red line, which is a 200-day moving average, has been cut downwards by a 50-day moving average as a thinner line. The price is below the averages and seeking lower levels. That tells you that the short-term outlook for the bank Nifty remains that of being under pressure. Turning to the weekly chart, we see that the price remains below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook also remains under pressure. The 25-week exponential moving average itself is turning to tilt lower. That itself is not very good news. And what we are seeing is a second consecutive bearish candle, though not very prominent, big or powerful, but a second consecutive week of decline. That puts the bulls on the mat. And mark-to-market margin pressures are definitely a reality here that will come into play. And do remember that we've seen a death cross on the daily chart. Also, if you are a Dow theory enthusiast who believes that bear markets begin only after a particular tradable security falls 20% or more from its peak, for those Dow theory proponents, the Bank Nifty has already completed that 20% decline, although it pulled up a little bit after that. But the 20% criteria, 20% fall criteria from its peak has already been met on the Bank Nifty, which is why on a relative comparative basis, the Bank Nifty is slightly weaker than the Nifty 50. In the week before last, the Bank Nifty was number 3 on our in-house volatility rankings. It fell 3 notches to number 6, not because the volatility of the Bank Nifty has come down, but because individual stock volatility has risen relatively faster and higher. Do remember last week there was a slam dunk decline in many stocks, so volatility simply went through the roof, and which is what is resulting in the Bank Nifty's volatility falling a bit. Last week I advocated a range between 37,000 round figure on the upside and 33,575 on the downside, which held perfectly well. Not as much as due to expertise here, but as much as more towards a smaller intra-week range of the index. In the coming week, I expect a range between 36,150 on the upside and 32,800 on the downside. Do trade with caution. This is a market that's treading on skid row. Friends, the Bank Nifty done. I now come to the Nifty 50, and what you see is the most liquid low impact cost derivative traded instrument on the NSE, logging declines of 2.31% on a week-on-week basis, and it fell on 4 out of 5 trading sessions. That's what's worrying me. Thursday's rally, I told you, was a sucker's rally. It basically was to flatter, to deceive the bulls. What you are seeing is a death cross confirmed on the Nifty 50 itself. The 50-day moving average is cut, the 200-day moving average downwards. A lower tops, lower bottoms formation is already in place. The bullish gap that this index logged a fortnight ago has been closed now, and the price is trading below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is also under pressure. Coming to the weekly chart of the Nifty 50, what you are seeing is that the price remained below its 25-week exponential moving average, which is more or less a 6-month holding on cost of a bull. So the medium-term bull is also under pressure. The index is making lower tops progressively from October till June 2022. October 21 to June 2022, it's been making lower tops. If it was to make a lower bottoms formation also, then you would see that the 15,500 level is not a holy cow. It may be violated, and that could basically let the cat amongst the pigeons. The 25-week exponential moving average itself is falling. That again lends to the concern that the bulls are kind of under pressure. And what we are seeing is that the price is unable to even test the 25-week exponential moving average. Forget about overcoming it. Now, if you are looking at a 20% decline from its peak, the Nifty 50 has not yet done that. It will happen at approximately 14,800 levels. And you might say that that's a long way off. And you are right. But do remember that the Dow theory, when it was propagated, did not have derivatives. You had the cash market. It's over a century old. Now, ask yourself this question, and this is something that differentiates you and me as real-world traders against the non-market participating spectators and commentators. No offense meant to anyone, of course. When you and me actually trade, you go long in October, the price falls, you have no choice but to roll your long positions forward. And you roll your position forward from October to November, November to December, and so on up to June, you would have incurred a cost of carry. You would have paid costs, commission, taxes, levies, etc., and your cost would be far higher than what the chart is indicating. Do remember that technical analysis charts, which so many people swear by, do not show you these hidden costs of what is known as transaction costs. So to a real world trader, the situation is a lot more grimmer. It's a lot more serious than what it would appear to an academician looking at pure numbers from the chart. Your cost of carry over the last 8 months has eaten into your capital. And we are not even talking about the emotional capital here. We are talking purely financial capital. Emotional capital, I can well imagine as a behavioral technical analyst, is depleted. Now, in the week before last, this index was at number 9 in our in-house ranking on volatility, statistical beta. It fell, not surprisingly, because individual stock volatility rose up. It fell 6 notches to number 15. But that doesn't mean that for you as a retail trader, the challenge has receded. It's just that volatility elsewhere has risen higher than the Nifty. The Nifty's volatility has by no means compressed significantly. So you must continue to exercise due care while you trade in the coming week. Last week, I advocated a range between 17,200 on the upside and 15,950 on the downside, which held perfectly well because the ranges compressed a little bit. In the coming week, I expect a range between 16,800 on the upside and 15,600 on the downside. Friends, continue to trade light. This is something that I keep telling you on my social media accounts. Please don't take money management and risk management lightly, because this market can take money from you like this. It's very, very volatile. It's likely to get even more volatile. Statistical beta is likely to go up in the coming week. The Jensen's measure and the Traynor ratio are not favoring bulls and the odds are not too great. So do expect some amount of nervousness. Friends, the indices done. I now come to the most popular aspect of this video, wherein I give you 5 stocks that have gained the highest amount of impetus, where you take the smallest amount of exposure, wait for large price moves to make your money, and 5 stocks which have seen the biggest amount of decline in impetus, where you'll have to take big exposure, wait for small price moves to make that kind of money. Why the difference? Because different mindsets, different traders. Scalpers will trade big quantities for small margins to flip their trade over, whereas swing traders will want bigger payoffs. So different traders, different mindsets, therefore different strategies. The highest impetus gainers for Monday, the list is led by AU Bank, second LIC Housing Finance, third Gujarat Gas, fourth Apollo Tyres, and number 5 Britannia. Low impetus stocks, where the impetus has fallen the most. The list is led by Exide Industries at number 1, Indigo at number 2, number 3 Tata Consumer, number 4 HDFC Life, and number 5 City Union Bank. Friends, the hierarchy of these stocks can change from hour to hour, day to day, which is why this list is valid only for Monday. Should you want this list to be updated for you, please join our Telegram channel. Our contact coordinates come at the fag end of this video. They are also there in the description below this video and in the pinned comment. You can even request to be added to our WhatsApp broadcast list. The contact details are given similarly. And I would request you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. I would love to hear from you in the comment section about the feedback you might have for me, and help me to reach out to fellow like-minded smart investors and traders like yourself by referring my video to your family and friends. Trade carefully, maintain your stop losses very, very diligently, and thank you for your patience in joining me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Wish you have a very, very profitable week ahead. Thank you. Bye bye.